While everyone is watching the stock market, Wall Street's biggest investors are quietly moving somewhere else. They're buying short-term U.S. Treasury bonds, not because they're afraid, but because they believe this is where the best risk-adjusted return is today. So, what do they know that most investors don't? Today, we'll uncover why one of the world's largest asset managers believes the next opportunity isn't in chasing higher returns, but in protecting capital while the global economy enters its next chapter. For years, investing seemed straightforward. If the economy was improving, you bought stocks. If the Federal Reserve was expected to cut interest rates, you bought long-term bonds. But today, something unusual is happening. Some of Wall Street's largest institutional investors are doing neither. Instead, they're buying short-term U.S. Treasuries. Why would professional investors settle for lower risk when markets continue reaching new highs? The answer reveals much more than a bond strategy. It tells us how smart money is preparing for what's next. Noah Wise, head of global macro strategy at Allspring Global Investments, believes investors should shift their focus toward the front end of the U.S. Treasury yield curve. That means concentrating on 3-month Treasury bills, 6-month Treasury bills, 1-year notes, 2-year Treasury notes, not long-term bonds. Even after the Federal Reserve decided to leave interest rates unchanged, Allspring maintained exactly the same strategy. Because for them, the opportunity isn't the Fed's announcement. The opportunity lies in how markets react afterward. Over the past 2 years, the Federal Reserve aggressively raised interest rates to fight inflation. As a result, Treasury yields climbed to levels not seen in many years. Today, investors can earn more than 4% annually simply by holding short-term U.S. government debt. One of the safest assets in the world. That changes the entire investment equation. For the first time in years, investors no longer need to take excessive risk just to generate attractive returns. But this story isn't really about bonds. It's about capital flows, because when institutional money changes direction, global markets usually follow. And history shows that the bond market often signals major economic shifts long before the stock market reacts. Analysis 1. Smart money is prioritizing capital preservation. The first message from institutional investors is clear. Capital preservation has become more important than aggressive growth. Instead of chasing maximum returns, they're looking for stable income, high liquidity, flexibility, lower downside risk. This is typical during periods of elevated uncertainty. 2. A 4% Treasury yield changes everything. For years, investors had little choice. To earn meaningful returns, they had to buy stocks. Today, that's no longer true. When short-term U.S. Treasuries offer yields above 4% with minimal risk, many institutional investors begin reallocating capital away from riskier assets. This is one of the most important shifts happening beneath the surface of global markets. 2. A 4% Treasury yield changes everything. For years, investors had little choice. To earn meaningful returns, they had to buy stocks. Today, that's no longer true. When short-term U.S. Treasuries offer yields above 4% with minimal risk, many institutional investors begin reallocating capital away from riskier assets. This is one of the most important shifts happening beneath the surface of global markets. 3. The Fed is no longer the story. Most headlines focus on whether the Federal Reserve raises or cuts interest rates. Professional investors focus on something different. They ask, what happens after the decision? According to Allspring, the answer is simple. Buy the front end of the yield curve, because uncertainty creates opportunity. 4. Why avoid long-term bonds? Long-duration bonds remain highly sensitive to inflation and future interest rate expectations. If inflation surprises to the upside again, long-term yields could rise further, which would push bond prices lower. Short-term treasuries provide investors with higher flexibility, lower duration risk, strong income while waiting for greater economic clarity. Global market impact 1. The U.S. dollar could stay strong. As long as Treasury yields remain attractive, global investors are likely to continue allocating capital into dollar-denominated assets. That supports demand for the U.S. dollar. 2. Emerging markets face greater competition. Countries across emerging markets may need to offer even higher yields to attract international investors. Otherwise, capital could continue flowing back into the United States. 3. Growth stocks may face headwinds. When investors can earn over 4% with virtually no credit risk, some may decide that expensive technology stocks no longer justify their valuations. This doesn't necessarily mean stocks will fall, but it does raise the hurdle for future gains. 4. U.S. corporate credit looks attractive. Allspring also favors U.S. investment-grade and high-yield corporate bonds over European credit. That reflects confidence in the relative strength of the U.S. economy. Solid corporate balance sheets and resilient economic fundamentals continue supporting American credit markets. 5. Latin America is emerging as a yield opportunity. The firm also highlighted opportunities across Latin America, where government and corporate bonds in several countries continue offering double-digit yields. For global investors, these markets present attractive income opportunities, provided they're willing to accept higher geopolitical and currency risks. Market lens insight. The stock market usually grabs the headlines, but the bond market often tells the story first. When institutional investors quietly increase exposure to short-term treasuries, they're sending a message. Not that they're expecting a crisis, but that certainty has become more valuable than speculation. And throughout financial history, major market trends have almost always begun with subtle shifts in capital allocation, long before they became obvious to everyone else. Conclusion: Allspring's strategy is about far more than buying bonds. It's a reflection of today's investment environment. Rather than maximizing returns, professional investors are optimizing the balance between yield, liquidity, flexibility, risk management. In uncertain markets, success isn't determined by who takes the biggest risks. It's determined by who manages risk the most intelligently. And right now, Wall Street appears to be choosing certainty over speculation. The biggest market moves rarely begin on the trading floor. They begin with quiet shifts in capital allocation, and today, Wall Street is quietly telling us one thing. In a world filled with uncertainty, certainty has become the most valuable asset of all. This is Market Lens, seeing beyond the headlines, beyond.